Welcome to our midweek Forex and futures forecast. As always, we need to remind you that trading involves risk of loss and is not suitable for all investors. Let's get right to the charts. First market we're covering the Australian dollar. The Aussie really been on the ropes, and it continues to be on the ropes. Continued weakness. We're on a weekly chart here to give you scale, and you've yet to see any kind of short covering rally all the way down. Let's look at the daily chart. You're just above the long-term support, that grand pattern support. That's even beyond, your primary pattern's down. You got to go 3 years back to find support, to find a trend line, potential support, and there it is. So just above 90 even, big level to hold. But they're trying to chip through it as we speak. So Aussie dollar pretty weak on the way down. We don't see a big turnaround for that market just yet. You continue to make lower lows. I was thinking before that this sharp down move may be a precursor to what we could see in some of these other currencies, potentially the euro. We already saw it in the pound, and the euro's down sharply, sure enough, the past couple of weeks. However, it is finding support right there. That's our 50-day RTT level, that day-to-day RTT level, and there's also a longer-term trend line in there. That's a primary pattern trend line too. You go back July to July now. That's been a full year since this market's held on to that bullish pattern. Granted, your long-term primary is down to 2.5 years is down. The secondary pattern down. In fact, you have more patterns down than up. That's a bearish development for sure. But you managed to hang on to support level here. We were saying earlier in the week that you needed to close below that level to challenge that trend line. You never got the close below that level. If I home in there, you'll see it. Yesterday just closed above it. Today you knocked stops around below it pretty good. You got below 29.50, but now it's closing stronger. And the bulls may be getting a reprieve here from the holiday market, but probably more to the point, the market's taking a breather here. The bulls and the bears are getting a reprieve here ahead of the ECB statement and ECB actions tomorrow. Generally, the ECB very supportive of the euro. It's in their mandate to protect the buying power of their currency. That's kind of unique for central bankers to have that in their mandate, essentially saying, hey, we're going to protect our currency. We're going to keep our currency strong. We think a strong currency is healthy. That's how the euro looks at, that's how the ECB looks at things. So tough row to hoe trying to stay short ahead of a ECB meeting, no doubt. So I think the combination of the U.S. holiday and probably more to the point that ECB meeting tomorrow is giving the bulls a reprieve here and allowing this market to recover some too. So I think if it recovers much more, you're probably going to see some potential short covering. If you look back in the past, what's happened on particularly last month, when Draghi spoke after the meeting, when the ECB said, no, we're not going to do anything with rates. We're seeing growth. We're content with that. If he comes across that way again and has evidence to show for that, you could see a potentially short covering rally. We're still bearish overall. I think when you pan out to the weekly, you could see that the majority of patterns are down. And what we're not even showing is that grand pattern happens to be down also. You have a long-term pattern of lower highs, lower highs, lower highs. So we think overall there's plenty of room down below. You may not get to that over the U.S. holiday. You may not even get to it this week. You may see a short covering rally in the cards there. So euro has a long and deserved history of running bears out of there. It's not the easiest currency to short. You really got to sell rallies, tough to sell breakdowns. We'll see, but we think you could have a pretty serious breakdown if you end up closing below that level right there, 29.75, and likewise taking out the trend line. Next market, dollar yen. Dollar yen is a bull. That's the bottom line with this guy. Taking a little breather today ahead of the U.S. holiday. You had a little bit of a disappointing ISM Purchasing Managers number today. The service sector was a little bit less than they would have liked. It's still above 50 though, however, so that's lending strength long term. However, taking a little bit of a breather today. Hey, this is a bull market though, no doubt about it still. Let's look at the U.S. stock market. Stock, they're hanging on. You still have a 20-day pattern here of lower highs now, lower lows, lower highs. We think that's something to be concerned about. We can't overrule a lower low now. Actually, you can see you're having resistance at that 10-day RTT level. You have resistance right there. If you can't get to it, you're not going to get through it, right? So we can't rule out a lower low here. We think it's a long-term bull, but you're in you got a pretty good seasonal for choppy times here. Summertime's known for a lot of indecision in the stock market, so we think you're going to probably see more of that. The gold market. Gold's another one similar to the Aussie that you're coming up on grand pattern support. Boy, they've really trounced the gold market. We've been bearish the whole way down. They kind of surprised us a little bit this last leg down, but hey, that's a bear market. You don't want to stick your neck out in a bear market. You don't want to look to play any kind of counter trend move because it's just too dangerous for us. For many miners, their costs, many of the new mines that have gone online, and their cost is close to $1,100. So you get down towards $1,100, that's awful. That's an awful dangerous level overall. The problem with gold though is it's not consumed. I mean, you're not just trading the production on it. You're trading the history of the world on it. Gold is all the gold that's been mined. Most of it is still out there. So that's the problem with being a bull on this guy. And that's really why we've been on the bear side so long, because once you lose momentum in a market like this, case in point, you guys that are students of economics, once you lose momentum in a market that has no yield, has no dividend, you're in trouble because there's no physical reason to own it. If in fact, you have to pay to store it. That's the problem with gold. So as long as the momentum is down in the gold, that's going to be a tricky market to contend with on the long side, in that you're coming up on long-term support. On the other hand, there's just no reason to step out and buy it just yet. Hey, thank you so much. As always, we got to remind you, trading is a risky endeavor and not suitable for all investors. Thank you very much. We'll catch up with you next time.